So Nicholas Merton at DataDash made an excellent video today, and the last half, or slightly more than half, I'm not sure how long I'm going to be talking here. I'm going to be playing some very important clips, in my opinion, of his newest video. His newest video is about 20 minutes long, and I took about 4 minutes of that, so I'm only going to be playing about 4 minutes of his new video that I think is incredibly beneficial for people who are interested in the understanding the market cycles a little bit better, kind of like how I've been talking about. For the last week, I've really been talking about Bitcoin dominance, Bitcoin gaining momentum first, and then that money flowing into the alts. And that is essentially exactly what he covers in a lot of his video today. So I think it's really relatable to my channel, relatable to what I've been saying, and relatable to people who are interested in better understanding the market, maybe even using it for trading. So people also interested in trading, this might be beneficial. And for people just interested in buying up more at lows, buying dips, and not necessarily trading and holding, this will be beneficial as well. So, just to start off, this is something he mentioned in his video, but we can just talk about this really quick. So when Bitcoin had its huge run-up, it peaked on December 16th, 2017. All-time high was right around almost 20,000. Sorry, 20,000. The all-time high was about 20,000 US dollars, and that was on December 16th. And so at this time, though, none of the other coins, if you remember back a few months ago when this was happening, the altcoins weren't doing this. But what happened after Bitcoin reached its all-time high, you can see Bitcoin shedding some value here. And there actually is a fundamental reason why it did that. And it's 100% because the money was flowing into the altcoins. And so if we go back to December 16th for Ethereum then, just to get a nice reference as far as time, Ethereum was not at its all-time high. It was around $668. And so on this chart here, after the date that I have my mouse on right now, Bitcoin was at 20,000 and then declined. But coins like Ethereum, Litecoin, IOTA, Cardano, not even just the top 10 or 20 coins though, a lot of the coins in the market, let me mute my phone real quick. Most altcoins, where they got their value is after Bitcoin started to decline. So as you can see here, December 16th was Bitcoin's peak, but Ethereum did not peak there. It went on for essentially another month to hit its all-time high of almost, about 1,400 US dollars. And why is that? That's because, like I've been saying for the past week, money flows into Bitcoin first and then tends to go out into the altcoins. And there's a reason for that. And I just want to highlight, before I play the clip of DataDash that I recorded, who, by the way, 100% recommend following DataDash. Probably the best cryptocurrency YouTuber in terms of raw information and understanding of the market. There are some channels that are, more entertaining, more this and that, but if you actually want to learn fundamentals and learn technical analysis about cryptocurrency, DataDash 100% should be on your radar and should be pretty much your go-to channel. Again, that's my opinion, but to me, he doesn't have any even editing in his videos. It's just usually 10 to 15 to 20 minutes of raw information. So 100%, if you're interested in learning, his channel is kind of like the go-to place. And in regards to a market cycle, he basically broke it down into three main points here. Entry of liquidity into Bitcoin, which is, all the money flowing into Bitcoin first. Stagnation, and then flowing into the altcoins. So pretty much when Bitcoin reached that stagnation point, it tends not to grow anymore. That money then flows into the alts. And the reason for that is for investors and people they want to make profits still, but they don't see Bitcoin as the go-to cryptocurrency at that time because Bitcoin has already kind of peaked for the time being. So tons and tons of money flows into the altcoins, and that's why you see Bitcoin dominance decrease around those times. And for this most recent particular example, Bitcoin peaked on December 16th, but then for an entire month after that, from December 16th to January 16th, we saw huge run-ups in tons of altcoins. And like you see here, particularly with Ethereum, this was January 16th, right here was its peak. And it began that run-up pretty much around December 16th, an entire month before. So this was all allowed because the money from Bitcoin flowed into Ethereum and all of those other altcoins. Three key steps essentially for dealing with market cycles: cutting out emotions, looking for positive and negative catalysts in the market, and staying ahead of the market in general. He also covers something I think is important too, which is the difference between day trading and swing trading. Day trading is trading done essentially a position open and closed within a 24-hour time period, and swing trading is slightly longer, 3 to 5 to a week or 2 weeks. Open a position and then wait, at least a week, at least a few days to up to a week or two before you close that position. And he pretty much said, and it's something I agree with too, swing trading is much more informed trading. You're really looking at longer term patterns. And day trading is generally just harder and kind of just based more, it's more based on luck. There is some technical analysis you can do in a 24-hour time period, but swing trading is much more beneficial, much higher chance of success if you know how to do it. And there's much more information and fundamental reasons why prices can go up and down within a longer time frame of up to like a week and a half or 2 weeks. So without further ado, I'm going to play his clip, and I'm going to leave a link to his video in my description. I would 100% recommend subscribing to him if you haven't.
People might say, Nick, this is over generic. This couldn't just be this. It couldn't just be this simple. It really is sometimes, folks, because people do not learn from the past. They don't learn how to cut out emotion in these markets, and that's why, for example, when Bitcoin went down to 6,000, we saw dramatic panic and kind of a sense of giving up from people who were Bitcoin maximalists, people who bought into altcoins and were going up and up and up. And then when they see a correction, they give up on it. There's a lot of people in the crypto space that have left as of recent and from December, January, and February. I have a very, very simple list of 3 major trends that you find in an overall market cycle. Because really, guys, again, we don't want to overcomplicate this. We don't want to do a lot of crazy technical analysis because a lot of this is sensed within the momentum of price. But there's 3 major parts of what we've seen in the past major cycles in regards to cryptocurrencies. Now, again, this has tended to change over time, and sometimes there will be additional phases, but this is what we've generally seen in regards to the structure of cryptocurrency markets, or at least what I've been able to analyze. So first and foremost, you have what's known as an entry of liquidity. Again, there I go using complicated financial terminology with words like liquidity. Basically, liquidity in simple terms is cash. It's money, an entry of new money into this market. And usually what we see is that money coming in and investing into predominantly Bitcoin, because Bitcoin is the first point of entry of liquidity into this market. As we want to see cryptocurrencies and the value of cryptocurrencies go up, as well as adoption, people need to purchase cryptocurrencies. They either need to have a stake in order to use those cryptocurrencies. They either need to have a stake for investing or trading and speculating in general in regards to crypto valuations. So they're going to need to go through that gateway to get into Bitcoin. We tend to see that a lot. For example, that's what we saw through the greater part of 2017 going all the way into December from January, the 20x of Bitcoin. And then what happens is, if we take a look here after December, we started to see a correction of some sort. We started to see a little bit of reality come back in for Bitcoin. And a lot of people who had entered that liquidity into Bitcoin and done very well. However, you would think that in some rational mindsets, you'd sit there and say, okay, time to maybe take some profits, or maybe understand that, yeah, we're probably going to go through a correction of some sort, and rationally act in that sense. But again, guys, when we're talking about human emotion and markets, especially in early markets like this, people get greedy. You have to understand that in these markets. And because of that, when Bitcoin stagnates, we tend to find that altcoins rise as a kind of a reaction from the correction or the stagnation of Bitcoin. Now, why is this? Well, because people have an obvious opportunity to go ahead and take more risk. Altcoins tend to be very low compared to Bitcoin after Bitcoin's had a strong rally. And if you have an opportunity where your Bitcoin is not producing the same returns as it was before, and you have all these cheap altcoins that provide an abundance of opportunity yet higher levels of risk and return, well, humans tend to take it. They go back to risk taking, just like they were with Bitcoin in the first place. But they increase that level. They start betting on all different types of altcoins. And we see this. If we take a look, for example, during the mid to late part of December when Bitcoin started to correct, look exactly at what happened to the other market players. We can even take a large one like Ethereum. Look at this. Right towards the end of December, we start to see a parabolic run-up going in through December and January. Take a look at, for example, Ripple, for example, had a huge rally, much like it did of the past year back in April, May, and June. So we have a massive parabolic run up in these short periods of time where people take excessive risk. They're flushing out all this capital from a multi-billion-dollar currency into the altcoins because they want to make more money, they want to take more risk, and they get greedy. And that's why some people get stuck buying at the top here too late, and they start holding the bags of people who bought down at these low levels. Again, look at the volume down there, guys. That's when the institutions buy in. They buy on lows. They buy when things are cheap, where taking risk is something they can afford to do, and it's a better bet for them comparative to just holding it in Bitcoin. So again, you see the trend all the time, guys. Cardano, for example, had a massive rally. You have all these different cryptocurrencies that have come up and done really, really well during these periods of time. So again, we see the stagnation or the sell-off in Bitcoin, initial sell-off, and it might hold relatively strong, but again, a lot of that liquidity and that valuation, it exits out. And we can see this in the chart here. Bitcoin used to hold 90 to 80% dominance in the market, but now over the past year, we've really seen a decline in that with other coins, coins out of the top 10, as well as just general other altcoins, starting to gain dominance comparative to Bitcoin in the greater scheme of things. So